Building a well-diversified portfolio is essential for achieving long-term financial success while managing risk. This chapter explores key components of portfolio management, including asset allocation strategies, rebalancing, and additional considerations, such as risk tolerance, investment horizon, tax implications, and behavioral finance. Asset allocation strategies. Asset allocation involves distributing investments among various asset classes, like stocks, bonds, and cash equivalents, to balance risk and reward based on financial goals, risk tolerance, and investment horizon. Here are several asset allocation strategies. 1. Strategic asset allocation. Overview: a long-term approach that sets target allocations for each asset class, based on your risk tolerance and investment objectives. These allocations remain constant over time, and are periodically rebalanced. Example: a typical strategic allocation might involve 60% in stocks, 30% in bonds, and 10% in cash. Risks: exposure to market downturns without adjustments. Fixed exposure means participation in both upswings and downturns. Performance drag due to diversification. 2. Tactical asset allocation. Overview: allows short-term deviations from the strategic allocation to capitalize on market opportunities by actively adjusting the portfolio. Example: temporarily increasing exposure to technology stocks if they are poised for growth. Risks: requires expertise in market trends. Incorrect predictions can lead to losses, timing risk, and higher management costs. 3. Dynamic asset allocation. Overview: involves continuous adjustments to the portfolio's asset mix in response to changing market conditions. Example: reducing stock holdings in a bear market to mitigate losses. Risks: highly sensitive to short-term volatility, higher transaction costs, potential for lower returns if predictions are incorrect. 4. Constant weighting asset allocation. Overview: maintains a fixed percentage of the portfolio in each asset class through regular buying or selling. Example: selling stocks that have risen significantly to restore original weightings. Risks: may underperform during bull markets by selling high-performing assets. Opportunity cost from rebalancing away from outperforming sectors. 5. Integrated asset allocation. Overview: combines strategic and tactical approaches, considering long-term goals, while allowing adjustments based on current market conditions. Example: starting with a strategic allocation, but making periodic adjustments as needed. Understanding risk tolerance. Risk tolerance is your ability and willingness to endure fluctuations in the value of your investments. It plays a crucial role in determining your investment strategy. 1. Assessing risk tolerance. Consider factors like your financial goals, emotional resilience, investment knowledge, and capacity for loss. 2. Impact on strategy. Align your investments with your risk tolerance to avoid stress during market volatility. Investment horizon. Your investment horizon is the length of time you expect to hold an investment before needing the funds. It influences your risk tolerance and asset allocation. 1. Short-term horizon. Typically involves lower risk investments, like bonds or cash equivalents. 2. Long-term horizon. Allows for higher risk investments, like stocks due to the potential for recovery over time. Rebalancing your portfolio. Rebalancing restores your portfolio's original asset mix after shifts due to market changes. Why rebalance? Manages risk by preventing overexposure to any single asset class and maintains alignment with original investment objectives. How often should you rebalance? Time-based, for example, annually, or threshold-based, for example, when an asset class deviates by more than 5% from its target. Steps for rebalancing. 1. Review your target allocation. 2. Compare current allocations with targets. 3. Buy or sell assets as needed to restore balance. 4. Consider tax implications when selling assets in taxable accounts. 5. Monitor regularly and rebalance as necessary. Tax implications. Understanding tax implications is vital for efficient investing. 1. Discuss strategies like tax loss harvesting and choosing tax-efficient funds to minimize liabilities. 2. Different account types. For example, taxable versus retirement accounts have varying tax considerations. Behavioral finance. Behavioral finance examines how psychological biases affect investment decisions. 1. Recognize common biases, like overconfidence or loss aversion, that can lead to irrational choices. 2. Implement strategies to mitigate these biases, such as setting clear investment rules or consulting with a financial advisor. Specific asset classes. Understanding different asset classes within broad categories can enhance your portfolio. 1. Stocks. Differentiate between large cap, mid cap, and small cap stocks based on market capitalization. Large cap stocks offer stability, while small cap stocks provide growth potential, but come with higher volatility. 2. Bonds. Distinguish between corporate bonds, higher yield but higher risk, and government bonds, lower yield but safer. Practical guidance for rebalancing. Providing practical guidance can help investors effectively rebalance their portfolios. 1. Use software tools or platforms that offer automated rebalancing features. 2. Visual aids such as charts or graphs can help visualize changes in asset allocations over time. Conclusion. Building a well-structured portfolio requires thoughtful consideration of various strategies and personal factors, such as risk tolerance and investment horizon. By understanding these elements and incorporating disciplined rebalancing practices, investors can create resilient portfolios that navigate market volatility while maximizing potential returns over time.